Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I had a question on the YouTube channel to talk about investing during inflation times and during wartime. So I thought I would cover those two topics. So first of all, when we have inflation, you would want to look for companies that have pricing power, such as name brands or essentials that can pass the price increases on to the customers. For example, companies with strong brands or that operate oligopolies can pass the price on to the consumer. Commodities also tend to go up. Things like energy and inflation are positively correlated. Real estate is an age-old inflation hedge because real estate really goes up at the rate of inflation over the long run. Financials also are good bets with inflation. So banks get bigger spreads between what they get the money at and what they lend it out at. And insurance companies get better returns on the premiums that you've paid them when they invest them, usually in bonds. Stocks will outperform inflation in general. So stocks and stock funds are indirect hedges. It may seem surprising these days because the markets are volatile and are reacting with sell-offs to the news of inflation increases. But over the long haul, stocks tend to do all right when inflation rises. The first reason is simply that inflation applies to all assets, including stocks. Many companies have pricing power that allow them to raise prices. And of course, if workers are getting raises in their wages, they can afford a little more in dollar terms to invest in stocks. Next, you want to look for mature dividend payers that increase their dividend by more than inflation. Also look for strong balance sheets so they are not getting killed by high interest rates on their loans. The companies should not be exposed to labor increases, meaning that they have contracts, and they should also not have supply chain issues. And inflation-linked bonds or inflation-protected bonds like US TIPS are something to look for. And lastly, bank loan funds are mutual funds that buy loans made by banks or other financial institutions to companies. These bank loans are usually senior secured debt and are mostly rated below investment grade because the borrower's ability to repay may be viewed as speculative. Bank loan funds are not tightly linked to inflation, but they adjust up and down with changes in interest rates. So that makes bank loan funds largely impervious to rising interest rates. Bank loans have several risks. They tend to be mostly below investment grade or unrated loans, so you have credit risk. Moreover, they carry some liquidity risk. You may not be able to get your money out when you want to. Now, what not to buy during inflation? Well, price takers, companies with a lot of debt, including utilities, since that debt is going to start costing more. High valuation growth companies whose future expected cash flows are discounted more in a high interest environment, bringing their today's value down. Just keep in mind gold isn't an inflation hedge. It's more of a fear buy when stocks are going down. But gold will not necessarily do well during inflation. That has been shown very recently. Turning on to the unpleasant topic of war. Oil will do well because of the uncertainty, especially if the war involves an oil-producing country. Any company that supplies weapons or war-related materials, so the most obvious ones would be Raytheon, Lockheed Martin, Northrop Grumman, and General Dynamics, all US weapons makers. And of course, anything produced by any of the belligerents will become more expensive since there will be less of it, assuming that the production has to stop or at least slow down. During wartime, you want to seek out the cockroaches, the stocks that can survive disasters. For me, that has traditionally been railroads, healthcare, and phone companies. Today, it also includes high quality technology, currently profitable companies that are reasonably valued. Don't buy anything that is consumer discretionary, since people who are afraid typically don't buy nice to haves. At the start of a war, any war, the markets go down, but quickly recover and keep going up, usually reaching new highs before the war even finishes. There's no long term harm to the markets. So, that has been my opinion on what to look for during times of inflation and during times of war. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.